I'm St. Gardner, Chief Investment Officer at Sandaire, and this week my topic is entitled, What is the Market Discounting? With the MSCI index of companies globally having recovered to near levels seen at the beginning of the year, it would seem that investors have decided that the coronavirus will have no lasting impact on future corporate growth and profitability. Indeed, some markets have reached new highs, with the S&P 500, which took just 22 days to fall 30% in March, having gained 38% in just 50 days subsequently. Of course, confidence has been bolstered by the huge additional stimulus, but the rally in markets is against a backdrop of one of the worst expected downturns since the Great Depression, according to the International Monetary Fund, which expect the global economy to contract 4.9% in 2020 before growing 5.4% in 2021. The fast shrugging off of the immediate issues perhaps seems to relate to a historical precedent of health issues, combined with a fast-paced and substantial government stimulus efforts, and perhaps plain animal spirits in the face of adversity. Previous health crises have had a temporary effect on the economy, and so it stands to reason that this time it could be the same, and the medical industry will either defeat the virus or humankind will adapt our way of living and working to cope with it. Markets tend to look through current woes and focus on the expectations of earnings into the future, investing in those firms which the consensus believes have good prospects of recovery, or with those where the investor feels that the market's expectations of future earnings is poorer than their own more bullish outlook for that company. Shares can exist for a long time and potentially produce an endless stream of earnings. It is this long-term belief that keeps those with wealth and assets and with no immediate spending need, but a desire to at least retain the purchasing power of their money, to keep them invested in for the future. Short-term dips in earnings will have minimal impact on value of long-term earning streams. It takes a sustained hit to earnings and or a loss of confidence to create a longer-term bear market. Confidence is clearly in abundance, which we can see through the price-earnings ratios, which remain higher than the long-term average, but not massively so. Nevertheless, there are costs associated with even the basic hygiene methods being instilled upon people and businesses, not least the risks that lockdowns are reimposed and then lifted, and then reimposed again in a perpetual cycle that prevents businesses over an extended period returning to the earning streams they previously enjoyed. In conclusion, therefore, there remain significant risks to the level of ongoing corporate earnings and thus their stock market valuations, and we should expect to continue to witness heightened volatility until a more defined trend emerges. Thank you for watching. This has been my weekly investment update for Sandaire on Air.